said, let's do a next session where we just go completely through my deck. So
all right, we're open. Let's
fantastic.
get them in, then we can hash it out.
I love it.
Go easy on me though. I had a rough night. Okay, so welcome. Happy is it Thursday? Thank goodness. Okay, we have, yes, macro to micro power hour. Thank you.
5 o'clock in Halifax.
Exactly, 5 o'clock in Halifax. I'm so happy to be joined by Bob MacMinn, my favorite oil trader. And this is a regular session that I do on Tuesdays and Thursdays, but with Bob, it's extra special. And for those who want to know who he is the man behind a lot of phenomenal oil calls. And in fact, I think we might be, for the first time in 2 years, not aligned.
I love it.
I think we're not aligned. I think we're going to have a tussle here today.
That's what makes a market, right?
All right. So I have his bio up here. He has definitely been involved in the oil markets and your father before you. And this is just a huge opportunity to talk oil. And I'm going to throw in some macro because I know that you're not a big, focused macro guy on oil, but I think there is a lot of macro as a tailwind for oil right now. And so you're my guest. You also have to hear me talk about it. So, and by the way, I'm Samantha Leduc. Yeah, founder of LeducTrading.com. And when this webinar is over, I will post it to my Leduc Trading YouTube channel, and it'll be here, macro to micro power hour. And we did one, I don't know, was it 2 months ago?
It was in November, I think it was.
Gosh, that far. Okay, it was, so it's definitely time to go over it.
It was. How did the SPAC call go, by the way? That looked very interesting.
The what?
The SPAC call. Your SPAC. Can you do an hour on SPAC? Special purpose acquisition.
SPACs. Yes. Yeah. It was phenomenal because the first one we did in January was, hot fire flames and everything was going up. And then we did this one most recently, and it was the opposite. In other words, the issuance, the amount of supply was going to basically, the weight of it was going to fall just on the weight of the supply of all the issuance. And sure enough, it dropped like a rock, right, in this NASDAQ sell-off when we got that another energy burst, that rotation. So it was a phenomenal timing to do that, literally right before it fell. Yeah, you're back in November. Anyway, but this is my YouTube channel. It'll be here. That's all I wanted to say about that. And let me stop sharing so we can talk. So one thing I did want to put up here. I did a video. You're going to laugh. Maybe you're going to laugh. I don't know. Did you get a chance to look at my video? You won't believe Samantha's higher oil call.
No. Is there a reason why you didn't send that to me?
I probably didn't send this to you, but you got to check this out on my YouTube channel because, can you hear me?
I will. Yes, perfect.
Yes. Okay. And where are we here? No, good. So long story short.
So by the way, you and I are usually when I call you and say I have some conviction on something, you and I are usually on the same page. So I'm glad that we're not maybe on the same page. So
I don't think we are, but to make sure, since I've already published my written analysis on that call and also a little video snippet for free, I know what I'm thinking and why. Share. What is your oil analysis now?
Oh wow, we're just jumping right to like telling me what's
I gotta have a little bit. Just a little bit.
I just think prices are ahead of the fundamentals. And is there an oil bear out there?
Is there what?
Is there an oil bear out there?
That's a very good point. Yes, there is a sentiment of only higher oil. The wirehouses are coming up.
Have you heard one? Or I haven't heard of a bear.
I have, but they are the
they're hiding.
I got the term today from a client. They are the melt up deflationists.
Right.
Meaning we're having a melt up, but it's going to be a massive deflationary bust. And this oil spike is a precursor.
Yeah.
So they are bears. They're just waiting it out.
So I know. So that's a great intro for a discussion. We had sort of a little script, so we're going off that already.
No,
right?
we'll do it now.
Okay, cool. So, but first, let's talk about trading versus forecasting, right? Like I learned long ago not to forecast. I mean, there's some people that are forced to make a forecast every day. You have to make a call. I don't. I spend almost all the time not knowing and watching. So I've had the privilege to work a lot on the hedging side, particularly for end users, of course, who are short the market, right? They have to buy fuel in the future. So I've become disciplined in terms of wanting to identify risk of what I would call sustained higher prices, right? So can oil prices go higher? Can they even spike? Absolutely. And we'll talk later that I've actually have exposure to that spike. We talked about tail risk. And in our stranded asset trading methodology, we want to always be exposed to upside price movement through, Exxon, for example. So I don't tend to like to get pigeonholed into I'm an oil bull or an oil bear. I'm trading the oil market that's in front of me, and that and assessing sort of risks and opportunities along the way. So can oil prices go higher? Sure. I hope they do. Actually, it'll be accretive to me, but I don't need to carry that forecast around every day. And I learned that long ago, that because then I own that forecast, and I don't need to own stuff. I just have to trade profitably, right? That's what it's all about. So.
And you also have a fund that is
I'm trying to start a vehicle out here, with another partner, and so we're going through the regulatory hoops to get that going. So that's exciting, and
it is very exciting.
Yeah, it's always a struggle. The regulatory side and the paperwork and that stuff is always timely, as in a long time. But I'm looking forward to that, which is going to be good. It's going to be a lot of fun. Hopefully, I can go back on with my partner someday, who has a completely different methodology and other asset classes. So as you know, I'm just exclusively trading oil and derivatives and stocks.
Yes, tell us about your background, because this is helpful to kind of frame the conversation.
Sure. So I've been in the oil business since 1984, almost exclusively in the downstream side. So got a chance to do a lot of supply trading, hedging, trading my own PA, owned my own fuel company, was involved in industry associations, and had my own, used to publish my own newsletter called the Petroleum Alert back in the 90s. So sort of watched the oil market trade tick for tick for, what's that, 16 plus 21, 37, 38 years. So, my own style has evolved over time, which we can talk about. But so I just exclusively play in the oil space. And so I try to build a system or a process where I don't have to, you made comments earlier about macro. And I think we talked about this in the November call, is I don't feel like I have to know macro, because I have a broad enough group of indicators that I score every week that'll confirm to me, I think, some of the same things that you do with a different analysis. So those macro trends or correlations will filter through the indicators that I'm looking at that are germane perhaps just to the oil market. So we're just coming at it from a different point of view. I joke around and say macro's lazy. And I think one of the things that attracted me to your trading style was just first of all, just your mantra, which is micro to macro, right? And I think that's what makes you good. I think there's one common thing that we found talking to each other's stuff like flows and that are really important. And I'm not like microscopic in my flow analysis, and you are, which is really good. So I see a bit of it. And what I found is that, I have a broad enough group of indicators that in any given time during different market conditions, different things might be important. And it's been really sort of interesting, call it the last year or two, where flows are really important. They're important signaler of things to happen. And it's really helped me out, which is good. And there's some puzzles on that flow stuff now, which we can talk about, which might be counter to some of the things that you're thinking about higher oil prices, in terms of there hasn't really been a lot of speculative flows into oil, at least into the paper side of the market, which we can talk about. And that's a sort of warning signal for me. And it's not dry powder thing. It's gone on for so long. It's just not dry powder waiting to happen. I mean, we're at $65. If long speculators are coming in, you'd think they'd show up to the party by now, right? But they haven't. And so that's a bit of a puzzle. So anyway, just been trading oil and being active in the market and watching it. And that's sort of my brief history or whatever.
So what are you doing now that you're off Twitter? Because honestly, this is where we would DM, and I'm following your sarcastic kind of lines. And also there's a lot of ballast that you give in your commentary, meaning the sentiment obviously goes way too far. Yeah. And you bring it right back quickly with a kind of a reality check that makes it more reasonable. Like, okay, yeah, like you said, right now, are there any oil bears? And I think that's a really good point. It
Yeah.
seems, and you're also, you're texting, oh my gosh, they just, this wirehouse just upped their oil price after it's already moved 100 points, or whatever. I mean, you're aware that it's getting frothy, kind of like the
Yeah.
SPACs that just went poof.
Sure. Yeah.
So
No, I just need to take a break for a while. I think Twitter is a wonderful vehicle. I think you mentioned the magic words, which is sentiment, which is largely, why I would look at it. And it was a great window on sentiment. But also just from a personal point of view, I think you can get a little immersed in it. I'm not saying I don't have an ego, and I used to have a lot of fun with it. And it can be a distraction too, and it can take up a lot of time. And so I just decided to take a break from it and just kind of get off on the
do you
side.
miss it?
And I do miss it a lot. I've got some good friends,
Yeah.
Connor Damone here in Halifax from Ice Cap Management, and Zach Rogers from.
I do know. Yeah, we follow each other. I like his stuff.
Connor's
Yep.
great guy, great young trader. He's gonna
Ice
be
Cap,
an
yeah.
awesome money manager, learning, and just a fantastic guy. And Zach Rogers, who's an analyst with Rapid End, they keep me posted on what everybody's saying, what's going on, and I get enough investment research and points of view just collecting over the years from people who send me stuff to still get that sentiment sort of flavor. But it's been sort of a healthy break. But yes, I do miss it.
All right.
And when I come back, I'll probably won't have that sarcastic edge, which maybe is disappointing to some. But
I hope you're anonymous. I still think which egg account is Bob's.
Yeah, for Bob's burner account. Yeah, exactly.
Exactly.
Yeah,
All right.
cool.
But one thing that you would publish, and I was able to grab on Twitter, but more recently, Market Ear has been kind of pushing out some of your charts.
Yeah.
So there is still access to your research and such. But what are your empath cheat codes that you reference in a lot of these charts? It's basically your punch list, if you will. But what does it stand for?
Yeah. So first, back to the Market Ear. How good are those folks, right?
No comment.
Like amazing. So I'm really glad that they did get behind a paywall. So, I'm trying to help them out, send some stuff over there. Yeah. Just fantastic folks on risk management. I mean, I was fortunate.
Oh, the Market Ear. Oh, yes.
Yeah, the Market Ear. Yeah.
It is bizarre to me that they are aligned with Zero Hedge, which is very politically slanted, but the Market Ear, brilliant. I love their stuff.
No, fantastic. And so I'm making sure I'm two people I send stuff to now, you and them. And just great folks, risk management. I learned so much from them, saw them go from, basically 0 to 30.
And we still don't even know who they are.
No, that's the great mystery. We do believe there's women involved.
Absolutely. The risk management is phenomenal, but then so is the tone. And then yes, in DM, there's a little he. I love that.
Yeah, exactly. Yeah. But so maybe it's a part of my strategic planning background. It does kind of frame my trading, but I just like to, every year I'll establish some themes or whatever. And actually for 19 and 20, it was the same that I developed at the end of 18 was, I called it the 4 Ds, which was deglobalization, debt saturation, decarbonization, and Donald Trump. I was searching for a D.
It works.
And he's gone now, which I know you're happy about.
I am.
But that was more the Ben Hunt type of, markets as political utilities thing. And it really helps frame, it helps me frame a lot. And if you think about, and I had some strong views that the world was going to deglobalization, and that was not popular at the time. And of course, we know debt saturation is all around us and continues to grow. And decarbonization, and the energy transitions become a lot more important. And then, we've seen how politicians and people of authority can impact markets. I mean, we've seen that with the Fed, obviously, and have been for years. So I ran with that for 2 years and just got a little tired. This year, I came up with the 4 S's. And I think it's socialism, debt saturation. Yeah.
Was it stagflation?
I call it stayflation, actually.
Stayflation, that was it.
Yeah, sustainability and solvency. Sorry, not debt saturation. So, somewhat along the similar lines, just to train it up, but just a little bit on stayflation. I know they're talking about once we get past the vaccine rainbow here, that we're all going to run out and run all over the world and chew up all kinds of demand. I just really don't buy that. the stuff I see and just how I'm living my own life and my friends in the general environment we're here in Canada is that I think things are coming back more where we're just going to stay closer to home. We're staying close to our family units. I think it's been a real, we could talk about that for a while, but so I'm not calling it inflation or stagflation. I'm calling it stayflation. And I learned long ago that oil is all about movement. It's economic movement, it's people movement, and I just don't think we're going to move around as much in the future. So that's a theme that we're going to kind of build on here, and we'll see what happens with the vaccine rainbow with respect to petroleum. And so I just have those framed as, when I get into larger trades, there's always a check back to the larger strategy to see if it fits into these themes that I've developed. So for us is what we're working on in 2021.
Yeah, I think the stayflation is interesting because, anecdotally, Norwegian yesterday opened up their lines for bookings and it was their busiest, day ever.
Yeah,
At the same time, the money that's going out, especially with unemployment benefits continuing, there are going to be difficulties with small businesses hiring when there isn't the incentive. Some folks don't,
I mean,
go that way. So it's going to be a little bit sticky. We need a little bit more sticky.
Yeah, I guess I'm typically skeptical by nature. So, I think the ugliest words I heard this year is, pent up demand. Like, it's like we're all going to go out and take 10 cruises or drive around 3 times as much once we, get our vaccine badge. Like, I just don't buy into it. And there's a lot of people. I mean, I think some of us are blessed that are really hurting now. Like their stacks are depleted. They're out of work. There's a lot of businesses that are really hurting, like really hurting. I know of some very sad stories, like lots of them. So I don't believe in the pent up demand story. I believe there's tougher times to come, and I'm trading from that framework. I'm flexible enough to change along the way, but I'm holding that view until, what they say, I'll change my mind when the facts change or whatever. So can we go through a period here where demand and our own economic activity like spikes for some reason? Sure, but back to that sustainable world again, I think we're going to be a little longer getting back to normal.
So you're going to show us, I hope anyway, a reference on these, besides the 4 S's moving forward, and that is a framework. That's kind of your box, if you will. But then specifically, you've got this energy index that you do, and your cheat codes that you do, and it's
so I put our heat map together at the end for you.
Oh,
we
good.
weren't supposed to do any charts today, but you want to see all kinds of charts, so I put a bunch of charts at the end for you.
Because I share them with my clients, and I will interpret them best I can, but it needs the bob spin. So it really does need your.
Thanks. I appreciate that.
Yeah, it needs your interpretation.
Cool. Yeah.
So what are you still in? Because I know you have had tremendous success, and you're a concentrated trader. So not like I trade small and lots. You trade very, very large and few. So you said you're now you're still in Exxon, but you're selling calls against it while it kind of travels about.
I think I got a current position. I think it's long Exxon, just under 55, and sold some October 60 calls or something. So that's it really. So and that my stranded asset, call it strategy, is tied to the energy transition. As you know, companies are jumping off to get on the ESG rainbow. People are trying to be renewable companies. They're trying to be power companies. They're ending their companies because they couldn't survive in the current economic environment. So I decided a couple of years ago that I just wanted to own companies that are staying in carbon, if you want to call it, adjusting to the energy transition, and that are going to benefit from people getting out of the business, being forced to be out of the business. And I call that stranded assets. And so obviously there'll be periods of time, and this won't be linear, by the way, which is a question I asked someone this morning, like, is that it? Like, we're at $65, we're going to 100, there's $20 crack spreads. Like, is that it? Is it over? Because there was a time a few months ago, which I was explaining to my buddy, where I was reading a stranded asset story every day, a refinery closing, an EP company going out of business. Like, I haven't seen anything. So is that it? Is that it? We're over? No. So I want to own companies that are going to be in the carbon game to the end, to what I call, thanks, I'll turn the lights out. So so that's a choice of both format and the company. And so the format, in my mind, coming from the industry, and how the type of company I want to own and stay in to the end, is an integrated company, not someone that's in the E&P space, midstream, merchant refiner, downstream marketer. I want to own an integrated oil company. And there's really only two in the US, is Chevron and Exxon. So I just picked Exxon. And so how I'll trade the fund is I'll just always be long Exxon. And so the degree that I'm long will just be either size, or in bear markets, I'll sell stuff off against it and trade it on a relative basis because I believe it'll survive over time. So, it was amazing when Exxon was down the spring to $32. I'm talking to people and they're going, oh, ESG is going to put them out of business. And I just want to own it. If it's going to blow up, if it's canned goods in a mountainside cave, like I want to go down with Exxon. So we'll just trade around Exxon, and that gives you all kinds of optionality. As we talked about tail risk and geopolitical risk. Like, so you own some Exxon, so you have tail risk inherent in not even having to buy tail risk in terms of cheap $80 crude calls or something. You're just naturally exposed to that. So Exxon's the company I want to buy. My theory is stranded assets. Thanks. I'll turn the lights out, and I'll turn it out with that stock. Now I say only Exxon. Of course we'll buy other equities and do other things depending on the environment. Where we see favorable conditions for crack spreads, or obviously E&P companies can benefit from crude strip going up. So there'll be different times when that leadership will change within that mix. Mm-hmm. But I just like to keep it simple. Like you say, early in my career, over traded like crazy, traded everything every day. My broker used to say, Bob, there's a trade every day, but you don't need to trade every day. So I just.
But I don't know how you have resisted the basket trading, because for me and my clients in my trading room every day, I'm like, since that $32.60, right, going long in Exxon. Yeah. And my intermarket stuff. And then I see the E&P plays like the CPE, right? Yeah. This is from 14.50 just recently to 40. This is the fun of basket trading, a theme, or the refiners. Crack spread is doing beautiful things for the refiner margins. I just love the refiners. So how can you resist?
Yeah, well, one, even though I used to overtrade, I can't hold anything for a long period of time. So even within my strategy, I can't sit. So I'll do something like we did recently. We'll sell off some calls, and then I'm kind of locked in because no, I can't do that. But I did learn the lesson on over trading from my perspective. So I like to watch. I don't trade much, and because when I do trade, I have to trade, a lot larger than most, and I have very little, obviously, latitude for any type of pullbacks when you enter something. So I'm just not trading often. It just fits my personality than it. It's not an empirical decision. Yeah.
And there's no question I like to be busy. So when I think oil's going to spike, I want those E&P plays, what you call the flat oil, right?
I mean, I'm not here to tell anybody that
the safer ones better. I'll say trade Exxon, but here, if you want something that moves really fast.
Great. Yeah. It's just for me,
it's not done. My intermarket says it's not done. So
it may not be. So, I just see some stuff that's, because I don't trade much, it just sort of troubles me. And so I'll just wait. I'll wait for the top. And so I'm not saying it can't. I'm just saying I won't. And I think you have to pick a trading style. Go ahead.
Besides the lack, which you already kind of referred to, of kind of the sponsorship, if you will, right? Mm-hmm. So the speculators are just not there in size long. What else bothers you? And the sentiment, there are no bears to find, really. They are the melt up deflationist bears, right? That think it's going to spike and then crash. But the point is, you don't have a theme that it will spike. You just have a theme that there isn't a strong enough case fundamentally for it to move higher.
In a nutshell, yeah. Like I have this question: is it a supply deficit or is it supplier discipline? So to me, it's supplier discipline. OPEC Plus has, who cares the exact number? 6-8 million barrels a day crude off the market. Refinings are running. I mean, we had the Texas weather event, but before that, 1.3, 1.5 million barrels a day that they're not running. Before the Texas weather event, that's supply discipline. That's not a market that, supply's totally tapped out and demand's ripping. Neither thing's happening. So that, to me, that's the price is firm due to supplier discipline. And so when does that discipline ease? And is what's happening now already in the price? Like you'll see later, we have a crude chart here. The market's in steep backwardation. So that usually implies that the front or a spot is incredibly tight. It's not. Like there's even some people starting to come out now and say, it's not. There's plenty of oil around in spot. There is. and the back end, just 12-month strip, is $5-6 cheaper. So, so a lot of the energy equity thesis is, well, the back end's going to rally, and that's why all these, E&P companies and energy companies are undervalued. I think the curve has it right. It's the supply that's going to come later. That's why it's cheaper. So, and the front end is the vaccine rainbow, which is, the pent up demand, the narrative, the whatever. And so to me, the curve has it right. So yes, it's, and if it isn't, it's already in the price. So if crude, and it can, but can't, if we were going to $80 a barrel or $70 a barrel and staying there, why isn't the collective wisdom of the market buying that back end? That's a pretty good trade, right? You can buy spot $5-6 cheaper than, or back end 12 months out, $5-6 cheaper than spot. So
they read your report and they're fundamentally like, why?
it doesn't hunt for me. So,
okay.
So I'll just watch and see what happens, and maybe the back end does come up and everybody's great, but I'm not committing my capital to that play, not that specific play.
When have you seen it last do anything that you didn't expect, like really move?
Well, the two biggest puzzles now are, to me, the spec interest, the lack of spec interest in this rally, and two is the backwardation is really a bit of a puzzle to me, or whatever. So those things, they'll reconcile themselves out. We'll figure out why. But right there now, that's a bit of a puzzle to me. Pull up a chart and look at all the energy trading instruments, like futures, CL, USO, Oxy. What's the E&P ETF? Is it XOP? Yeah.
Yeah, XOP ETF.
XLE. And this is a paper-led rally, right? It's papers outperformed. It's a CL rally. So, in different times, this is what we talk about, oil's not XLE. It's funny, you see a lot of this analysis and they have a Brent or a CL chart up, and then they put CLE. XLE is not oil. I call it, it's not oil unless you don't want it to be. So there's different periods where that leadership will flip around, but this has been a paper-led rally, right? And so, and the energy stocks have done fantastic. I mean,
but it makes perfect sense to me because the macro tailwind of inflation expectations and rising CPI and all of that. And to me, there's a lot of the vaccine rainbow that you've talked about with increasing demand and stimulus being stimulative to oil, and that payment, if you will, for consumers to get out and travel more and drive and fly and all that. It seems like the expectations are driving this, and the Fed's fine with yields moving higher, it seems.
Yeah. So why do energy equities not trade at a premium to paper then? If you wanted leverage in the gold market, would you buy gold or would you buy GDX?
Well, there is a huge divergence between the paper and the physical in gold.
Yeah. Now. Yeah. But normally you'd buy gold miners as leverage on the gold price, right?
We didn't lose sound. Someone just saying, if anyone else has an issue with sound, let me know. Thank you. So yeah, that divergence between paper and physical has occurred in several markets. Silver we kind of dismissed because we already know it's highly let's say manipulated in the futures and such. But for right now, the physical, you're looking at that divergence, but I'm talking about in the past. Are there any other moves historically that you can really kind of point to that surprised you? The price got way ahead of the fundamentals, and how did it end? 2008 as an example?
Well, badly, I guess. You just draw a line through $65 since when NYMEX crude started trading. I mean, there's been longer periods where crude stayed up there, but it always ends pretty ugly, like very ugly. So, and
that's why I came out and said, okay, we got up here. Now what? You're in digestion mode. I'm just saying, if we get and stay above 65, it's
great. Remember last January when we traded the missile attack on the Saudi facility? That was interesting. And we just had that the other night, right? And it's around a similar price.
It didn't last though, for more than 5 hours. It was so brief. It didn't even.
It was, yeah.
So they're getting more reactive or reflexive.
Yeah. These pullbacks are interesting too, right? I mean, we've had 6% pullbacks in crude here. Really tough to position trade in that environment, right? That's the incredible part, right? It's like people can put a forecast in, but try trading that. Try trading a 7% pullback, and you're down 5%, and you're in size. Well, is this just a minor correction? Like, these become difficult decisions when you're a trader, right?
This is definitely why the 65 is so important in my forecast. Above is bullish. If we stay above, it's bullish. Otherwise, it's a high probability short below. But I don't think we're gonna go directly. I think it's going to be a digestion period. So, which of the, let's just say, time frame? I'm not which of the timer. How much do you think this is going to chop about with these tough, like you just mentioned, we've had 2 very sharp pullbacks in the past 2 weeks. This I call it fragility of chop, right?
Yes, I love that saying, by the way. That's so good. I love that.
No, I'm glad, but it is how I feel. I'm looking at the markets, not just the oil markets, and they're all kind of doing the same thing. This, okay, we're bonds have already come down 20%. What's next? Yields for sure have hit the tech sector as anticipated, as they would, and now all of a sudden higher yields are fine. It means the economy's better. Buy tech. I love how the narrative changes all the time, but yours doesn't. In your stranded asset theme, you are still,
it's just a question of, you're waiting on say an integrated oil company. But we'll go through a couple of brief charts here. I like just a monthly chart on oil for the 3 products, gasoline and
please do, because I also
ULSD. And I found, in terms of my longer term work, just simple ranges work for me. And so I actually agree with you, like above 65, we'll go to 75. So, but I still reserve the right to trade my own book. And I'm not comfortable with a bunch of things here to get heavily exposed to that move. But it sure as hell looks like it will, for sure.
Yeah, I'm looking for you want to share your charts? I
can. We're ready to go on to that. Yeah, we're great. Okay.
I want to get some time also. If any.
Yeah, you need to disable. You need to allow me to share.
Yes, I will do that.
Okay, cool.
I was looking for something. All right.
Nope.
Hit it.
There we go. Wow.
Pretty backdrop. Halifax.
Let's go. Yeah, it was Halifax the other morning. Every day I get to watch that, which is pretty cool.
It's gorgeous.
So there's our social themselves, these stranded assets, stayflation. Do you believe at the bottom that Exxon and Chevron were talking about getting together? How cool would that be?
Mega big.
Yeah. Here's the ESG rainbow. There's Beyond Petroleum, and I say, I like the old songs like Exxon, right? So
tight fractal.
There you go. So this is crude oil, to your point. I mean, I have this band at 65, 66 just there. This was on the weekend, of course, because I'm using a monthly. So sure, look at that 76.90 high there. So, we get above 65 here on a monthly basis, sure. A little troubling on the volume here, Samantha, longer term. And of course, momentum is elevated. That doesn't mean, of course, as you know, it's actually most dynamic markets, a condition for some serious extension of prices. But so, yeah, I mean, that kind of works for me. Certainly, I'm not going to argue with you technically. Heating oil, and I do a lot of ULSD hedging work. So this 164 was always an interesting number. You can see when we came down through that in the spring. So, I like these ranges, and products call it 164, 245, and we're right in the middle of that. So, we could get a pullback, pullback to 164 would be pretty substantive. Certainly want to be a buyer there. And then the upside range here, could be as much as 245. Momentum starting to get a little extended there. So, there's nothing technically that's signaling to me that we're crashing here. So gasoline, much the same. I like this sort of 180, call it, to 220 range that we're in. And so there's nothing really wrong there. Volume's a lot stronger on the gasoline side. And of course, momentum is elevated where it should be, since we've been rallying hard right off the spring or whatever. So just quick little snapshot. Gasoline demand's really been struggling. I mean, snap back a little bit here after the Texas weather event, but we've been the 6 to 10% down versus last year. Of course, we're going to have some bizarre comps once we get into March or April here. So But gasoline's been struggling. Remember, we talked about this chart before. I called it jumping the shark. I mean, the market has to jump the shark where gasoline demand goes positive versus 19. We're nowhere close to that. In fact, we've been sort of, but all the pent up demand and the vaccine rainbow is going to recover us from that. So I'm just kind of watching and see if it can jump the shark here. Distillate demand's been really strong for a whole bunch of reasons. It's really good. There's nothing wrong there. We're up 3% over 2020 and really strong. Even Texas weather event didn't have much to do with that. This is just the same chart on a year-over-year basis, 4 weeks. So, we're fine on distillate. Total, we're down about 7%, which is, 1.4 million barrels a day. We're below 2020. And that's just over a week. So, here's been the problem about recovering. I call it friendlier skies. Jet fuel demand, 500,000 barrels below last year. This is going to be the big one to get that going, and that's going to come back. We're not saying it isn't coming back, but it's been a slow process, but friendlier skies. Stocks of crude oil, obviously with all the production shut in, we lost some crude oil, but with the refineries being basically turned down, we had 50%, call it, refinery utilization in the Gulf. We're building a lot of crude here, 12 million barrels almost a week here for the last 2 weeks. So we're 40 million barrels higher than 2020. So there's no supply deficit problem in the crude oil market despite all the hype. Of course, gasoline, if you don't run your refineries, you're going to lose products. So, gasoline is tightening up, and that's very bullish. 15 million barrels below last year, 6%. And there's probably a few more weeks of draws there too until the refineries get back up and going here. Distillate fuel oil stocks are still above last year, but I call it 9 million barrels, but dropping with that refinery utilization being lower. And then total stocks. So this is what I call the big three. So you got gasoline, distillate, and crude oil. And we're still 40 million barrels over last year, which is 4.5%. So, are we coming down? Fine. That's also a seasonal move, as you've seen here. Sort of middle of March, the general tendency, obviously, you look at the 5-year average here for us to build stocks. So, it'll be interesting what happens here in the next few weeks on that number. But, there's no chronic shortage of products here. Right? I'm sorry?
Are you saying it's not seasonally strong into the summer months?
No, I'm saying seasonally total stocks will fall through this period. So that's not necessarily a super bullish event. It'll start building here through the spring and late spring and early summer. So we'll see if that happens. If it doesn't and they keep falling, well then, product markets and crude will start tightening up, and that would support the move higher that you're looking for. But I haven't seen that yet. So all we do, Samantha, is we just, we record and write this stuff down every week and watch. It doesn't necessarily trigger trade signals for us. It just basically says, where's the market at? What direction it's heading in? What's happened before? So it just becomes a sort of a pulse as to what's happening. And these are the refinery inputs we talked about from the storm. And before that, we had supply discipline here, right? So,
speaking of supply discipline, shale, think it'll stay conservative? They didn't last time.
Yeah, I think so. I mean, price will attract supply. Don't try to be a guru in terms of what the available crude is to come back. I mean, I do buy the argument that, that's probably constricted for a long time. I try not to get too tied up in that forecast because I believe that the price action is pricing a lot of that in. So I'm not trying to forecast, how much will get held back. But I know there's a lot of crude oil off the market now, and demand has to come back first too. The other thing I point out on supply discipline here now, particularly with respect to refiners, is if you look at the forward cracks, and we're going to talk about them, they're pretty nice. They're plus $20 a barrel, and I think it's $22 crack for the average distillate crack for 2022. So this supply discipline is probably going to start getting eased. People are going to start running here. So now that'll use more crude, but it's going to put some additional product back into the market too. So it's a double-edged sword here. So we'll just let this kind of play out. This is the gasoline crack, and you can see, the forward curves, which are these lines here, are above the 5-year average, right? So there's nothing wrong that's happening in that market. We have a very steep recovery in refining margins, and this is the distillate crack. The forward curve here for 2022 is $21.16 a barrel. The 5-year average is $18.71. So the refined product markets, in terms of refining margins, there's some stuff going on with RINs and that are inflating these a bit, which is a trading obligation with respect to refiners and renewable fuels. But there's still, these aren't depressed cracks like back in the spring that you see here, like, $5 for ULSD here back in June 1st. And there's the crude oil curve that we talked about, the steep backwardation, the spot 60, and this was yesterday actually, 64.44 and 58.80. And, there's 570, 580 backwardation here. So like, why is that? Geez, if I believe in the thesis that we're going to have sustained prices above $65, that seems like a pretty easy trade to me. Like, why would you trade in the front end? Let's just buy the back, right? So 12-month strip, look at how this 12-month strip, I mean, back on the lows, the 12-month strip was $25. It's $62 now. So if I'm at what point as a producer, if you're unhedged, that do you start saying, well, geez, 12 months at 62, that looks pretty good to me. So, we'll see how that kind of plays out or whatever. And then this is the real puzzle here,
Yeah.
Basically,
love this chart.
basically in all in 2021, and this is net large speculators. And this is all the products, by the way. This is CL, RBOB, and ULSD. So large speculators, like you would normally want to see price advance with a sharp increase in large speculative positions. It's just not there. It's a little different on Brent. It's actually, it's more normal, more favorable. In other words, it's a little more excessive, but that's just not a good picture for me. And I don't buy, well, that's actually, dry, the trading saying it's dry powder. Well, it's a long time to have dry powder. Like, when is the powder coming in? If it's all going to come in at $65 plus, like, I want to wait on that, because that's people that I think are late to the party or whatever. So. And then this is just our heat map. So it really doesn't generate any signals. So we look at 20 indicators, all the top, term structure, volatility, price, seasonality, trading volume, spec money flows, money flow, demand, exports, refining runs, margins, currency, geo risk, weather. And, if you take the top part here, is like this is basically price, and it's been very strong. And you expect that, price usually leads. But then you get into, stuff we talked about, spec money flows, open interest, product demand, stuff that's, just marginally neutral, maybe a little bullish. Refinery runs are, negative because of the storms. Currency is back and forth. As you know, DXY's had a tough day the last few days, so it's a little more favorable to oil. And then just to talk about this, this is something we talked about back in November, is that, we've been scoring geopolitical risk really high for a long, long time, because we just felt with the change in administration, with prices having a poor year in the Middle East, and just, the actions of the Iranians, that we just thought that there's something, it could be silly season there. And so we just want to be exposed to that, and we are, with our position in Exxon or whatever. And then weather is the thing that changes more week to week, but this just kind of gives us a picture. And then, we just like to put a really simple framework on it. And for us, it's like, we call it the vaccine rainbow and supply discipline. That's what's driving the rally. And we think it's ahead of the fundamentals and money flows. And so how do we trade that? Well, we just continue to watch, because we're not really convinced. So we'll join the rally when we see that fundamental and money flow improvement. And then, but really what we want to do is sell on this narrative exhaustion, which is maybe when the pent up demand and the vaccine rainbow doesn't really work out. We've had a saying for a while, the end maybe is the end, like when we're all good, maybe that's the end. So we'll just let that play out. But so that just gives us a pictorial. So sitting underneath this is what you mentioned earlier, which is our energy price index. So it's a little more elaborate scoring in all those categories and some weightings and stuff like that. But again, they don't really generate trade signals. They just help us assess the current market conditions and look for opportunities. And then we're just, you mentioned before, you called me an opportunist. We're just looking for opportunities, and then we just trade things much the same way you do, enter, exit on technicals, or just, trading pullbacks, or however, normal mechanics, block and tackle type stuff about getting in and out of trade. So that's sort of our posture or whatever.
Do you have any?
Feed the good wolf. Feed the good wolf. Yeah.
Do you have any, I guess, input for seasonality?
Yeah, I mean, there was a time, I mean, it's funny how you'd find this too, is you go through these periods in your career or your trading career where you put a lot of emphasis on things. I remember I used to get these books, I forget, they were from, is it Bernstein or something? I mean, I used to follow those things, so they used to have it right down to the day. And
Oh, the
you know,
cycle stuff.
yeah, just
Yes, yes,
on the
yes.
oil market for the last 10 years has bottomed on February 26th, and like you can get, I call it, sometimes this I call it subject matter expertise can really hurt you. You can get down the rabbit hole of like all these particular, those 20 indicators. And I try to stay as sort of generalist as I can, even though there's a lot of detail there, because you can get down the rabbit hole, and then that particular indicator or that particular, whether it's supply or demand, can end up being your blind spot, because then you're going, well, geez, this certain condition doesn't usually fit with this period. So and then you're fighting it, right? And you're mad at it. So I try to keep a lot of detail in our model, but not get down the rabbit hole of being a subject matter expert in every one of those individual areas. So it's just like technicals. Like I was a big technical trader. Now I just keep the charts as simple as I can, because I don't want to get too much subject matter expertise into my thinking. So
my approach is very much, and I don't even play poker, but I love the expression counting cards.
Yes.
So for me, it's very much counting cards. If I have all kinds of indicators, I want to know, probabilities, if you will. If I've got 3 out of 5, okay. 4 out of 5, awesome. Rare to have all 5 out of 5. But the point is that type of stacking and weighting the indicators. But at the same time, I mean, there are times where it's not really the best for swing or position traders to go short gold. There's the seasonality. Same thing with oil. So just wondering how much of that input.
I'll look quite a bit on it. I like seasonality, and there's certain times of the year for different products where it's really important, and I'll have to have a strong view to overrule it. So, but I try not to have too many rules, because sometimes I just like I say, most of the time I don't know, and if I want to trade on conviction with intuition that it somehow is connected to my models, I want to feel free that I can do that. So,
well, I take up very much multidisciplinarian, which is I'm looking at macro, and I'm looking, okay, yes, dollars and input. This yield regime, new yield regime, politically, monetary and fiscal regime change as well is all fueling, if you will, inflation expectations. The CPI will continue to move higher. Gasoline looks like it's moving higher, and that run, if you will, to me has put the tailwind of a bullish thesis. Then I get to that chart, and I had to go find it, but I found it. The one where you just showed me yours real quick.
Right.
This is that same chart, with a line through it, monthly. This is many, many, many years, and boom, from top, and here we are, which is why I said, okay, this can still pull back. I'm not saying, we're going to have the trigger right here and right now, but man, oh man, technically it's also looking good. And this happens to be a Morningstar formation for those who do candlesticks. So that formation is uber bullish, especially on a monthly. So there are definitely
no question,
technical look is also bullish. And then my intermarket is still stupid bullish. And I know this is kind of a little bit busy, but I'm going to show you anyway, because it is absolutely, if I can find it, there's pivoting on oil. Oh yeah, let's do that one. All right, so this is that article that I mentioned that I sent to clients. And obviously I'm really into the rotation, reflation themes when they appear. I want to have a lot of reason behind this. And of course, energy is that cyclical commodity trade, which you specialize in oil. So I love your insights there, but I'm looking for a basket trade of a particular sector to go long with clients or short with clients. And this is definitely, whether it be reflation because of yield, whether it be my intermarket because of growth is coming down from that September 4th peak.
Growth, yes.
Yep. To value, which is that factor rotation. I'm into that. And then I do my intermarket stuff. And this is going to be, again, muddy for most, but not for me. It makes crystal clear sense to me. And when we talked about this back in October, November, right? I'm like, absolutely bullish. And it looks like, and I had put back then that we're going to be getting into an inverse kind of situation where this is a shoulder, this is a head, and this is a shoulder. And this, by the way, I should explain, is a relative chart, XLE to SPY. In other words, this foretold in my, or supported my growth to value rotation theme, that
Nice.
energy would outperform SPY, relatively speaking. And in particular, that tech was number one last year. What has been the number one performing sector year to date in March? Energy. So it was at the bottom of the barrel, outliers revert. Anyway, so this is the kind of stuff that I like to do from intermarket. In addition to the macro, in addition to the technical, here's the other thing I've shown with you before, which was, again, November, you and I were totally aligned that oil was going higher, and with it, that whole reflation trade, which was my theme. So this is the kind of stuff, but I love, then going in and talking, what about inflation? What about the political, the fiscal, monetary regime change? And ultimately, it comes into big picture. These big wirehouses are recommending energy or oil as an inflation hedge. And there's precedence for that, right? So I'm looking at this going, wow, look at the carry versus other inflation, vehicles. It's relatively cheap. This is another viable.
There's backwardation in a lot of commodities, so yeah, carry trade going on there for sure.
And then within the commodity complex, CPI, as it rises, energy is actually beating out the other commodity complex.
Right.
So to me, I'm looking at this going, okay, stimulus benefits oil, consumer direct spending. Anyway, backwardation, which you've already kind of touched upon. You have your divergences. There's no question. I'm looking.
A lot of work there. I love it.
This is what I do for clients. And this is what I do in my head to figure out what's going on. Your approach is obviously different, but we come to the same place. But this is why I actually think oil, with what I just showed you also in that chart, for example, can be moving strongly higher. And I don't think that's good for the economy. So let's talk about that. What happens if oil moves strongly higher?
Well, that's what do you think the world can live on sustained $100 oil prices?
No, absolutely not. It's a headwind, strong one.
Okay.
But it does look bullish. So
sure.
To me, I have to,
my Exxon position is going to do well then.
Your Exxon position is going to do well, and
then you'll help me pick the top, and we'll trade the top together. How's that?
I hope we actually can catch it, because I think bottoms in this particular case, we had a lot of catalysts that were coming together. The top, if it gets too spiky, it's going to be quick, right?
Right.
So that's the trouble.
What catch it like Exxon from 32 to 62 or what?
That was gorgeous and slow.
Well, it was a pullback. It was a pretty sharp pullback there. Do you know XLE until recently hadn't even taken out its June 8th high? So.
Oh, this is true. It hasn't made up with even the February, the COVID, pre-COVID lockdowns and such. Yeah.
So.
I think that's another higher.
I think for us, we'll just wait, and we're exposed to that move. I hope it happens actually, but I'm looking forward to trading the top when it comes. The other side of this should be fun. We need another missile attack or something. Wars and explosions, we call it in our business.
Yeah, that's a tail risk we don't need. Okay, so what would be the biggest surprise? What you call the lunch? What the heck's it called?
Lunch bag letdown. Sure. The demand doesn't come back the way we all think it's going to. I mean, I think that's the narrative right now that's holding everything together. And supply discipline, but really it's demand. And so the biggest lunch bag letdown is demand. And so the V-shaped recovery, remember that off the bottom? I mean, that was supposed to be second quarter or third quarter 2020. Then it was supposed to be fourth quarter. Then it was supposed to be first quarter. And it's not going to be second quarter. So we'll see.
Oh, we'll see. Okay, so that's one thing to kind of keep in the back. And then if any changes to that speculative net long chart, which I love. And
I would really feel better if people
We're coming in.
Speculators had exposure to that. Absolutely. Trade with the flow, but where's the flow? It's just not there.
When
Now
they
it
will
might,
come in, when it's time to reverse. It's like literally last in, first
yeah,
out. But
late to the party.
they're late. They're smart. They're smarter than that. All right. So how can we stay in touch? Because you are off Twitter. Luckily, I know where to find you. But the point, how do we get more information and access?
Yeah, I'll actually send you my email address, and then we can put it up with the video or whatever, and people can reach out to me. So
awesome.
Yeah.
Okay.
What we can do is, let's stay in touch and come back in a few weeks and go through the deck again, see what's changed or whatever. So that's the part about doing the work every day is, you see things gradually changing over time. I write everything down. Actually, I have a book for the whole year and I write it down. I do my own Excel charts and that. People think that's goofy and a waste of time, but I like working with the numbers. I like seeing things change every day. I like looking in the cell next to it. I like grinding out a piece of paper, the crack spreads every day, and just it puts me looking at the volumes and open interest changes, and it just gives me a feel. That's kind of my edge. It's not wasting time. And so these things aren't gradual. That's the thing about being patient, waiting, is you don't have to trade every day. So, and I don't have to know what's going to happen. I only have to know when I want to make a trade, and then that just evolves on its own. So I've learned to be patient about the number of times I trade. Once I get in it, I'm still not patient, but at least I'm watching more than I'm doing, and I'm trading. I'm not forecasting. I think that's an important distinction.
And you're keeping busy with all this minute detail.
I got a bunch of other stuff going on too, but I'm having fun.
With your big positions.
Yeah, right.
That would be good because Derek, for example, in comments, when you mentioned you're getting your fund together, it's like, I'll give you money. So there is going to be some interest for sure. I don't know how it works up there in Canada, but definitely we'll have to come back when that gets announced.
Yeah, you're so good too. I mean, you're so sharp, and we were talking before you get on. I don't know where you find the time to do everything that you do.
I told you I'm underutilized. My kids are all in college.
God.
My dog doesn't want to walk so much. He's too old. And
I got a 17-year-old boy. He just got his license last week. So we were joking. It's cats in the cradle areas. See you later. Can I have them, please? He's heading out the door now. So
you're going to be a mess. That's all I'm going to say about that.
Yeah, no kidding. All right.
But for right now, I will say thank you again.
Oh, thank you. You're so good or whatever. We'll talk to you soon.
Another time.
Right on. Okay, Samantha.
I will have this up on my YouTube channel tonight.
Oh,
check it out there. And so give me this. I have several emails for you, but I want to know the one that I can put up on the description. Okay.
Great. Thanks a lot.
Thank you so much.
Okay. Take care.
Bye.
Bye-bye. Bye now.